10-year life. In other words, you can hold these employee stock options. If you were granted it today, you would have the right to buy the stock at a specific price for another 10 years, which would be 2021 somewhere. Okay? Whereas the exchange-traded options have a maximum of 2 or 3 years to expiration. So there's some differences. There's also restrictions on the employee stock options. They can't be sold. They can't be pledged. And they can't even be exercised until they vest, because there's this period between the grant date and the time that the employee actually fully owns the options, which is called the vesting period. Until he stays at the company in good standing, those options do not vest, and he can't exercise them. Whereas exchange-traded options can be sold the day the next day, or exercised the next day. So there's substantial similarities, but there's substantial differences. Now, exchange-traded options, if you wanted to reduce the risk of holding them, you can just sell them all or part of them, in 5 minutes. Whereas equity compensation, until they vest, you can't even exercise them, and you can't sell them at all. And employee stock options can never be sold.
Do you think that most employees know that, John?
I think, yeah, they know. They know they can't sell them. They know there's vesting restrictions, and they know that they're risky. However, they don't know the value of them, and they don't know the probability of losing that value. Okay? And they certainly don't know, in my view, how to manage them unless these people have master's degrees in finance and understand something about trading. But the companies really don't want their employees and even their executives, that is, CFOs and vice presidents and people like that, they don't really understand what they have, okay? And therefore, they don't know the true value of them. And the companies themselves want to give an impression that those options are less valuable than they really are, because there's a lot of, these days, there's a lot of observation about the amounts of money that executives have made as a result of their equity compensation. And these people who are the officers and the CEOs, they want to downplay that amount. And so when they value these options for their financial statements, they artificially value them lower than they're really worth.
But how do you, as a company, help employees optimize these options? One, as I understand, you've just said, by having them understand in a different way the true value of them. But then what? Well,
you see, because of the restrictions of selling and vesting and restrictions against pledging for collateral or putting into a margin account, because of that, it becomes more difficult to manage them unless you go to the exchange-traded markets and hedge them, or you can even call it insurance. You can buy insurance against losing their value. For example, if I were granted some employee stock options to buy Google at $300 a share 6 years ago, and those options still have 4 years of time to expiration, and I haven't exercised them yet, and the stock's at $500, well, I have a nice big profit in there. Okay, now, those options have more value than the difference between the exercise price and the current market price. In other words, if I have the right to buy the stock at $300 and it's trading at $500, you can subtract $300 from $500 and you say, well, those things are worth $200. Well, they're worth 200 plus some additional value, which has to do with a number of factors. And often, if the stock's volatile and there's still a good bit of time remaining to expiration and interest rates are relatively high or normally high, then the amount that's a value that's there in addition to what we call the in-the-money amount is large. And if you exercise those options prematurely, then you are forfeiting quite a bit of the value of your options. And if you want to manage it efficiently such that you end up with the most money, pay the smallest amount of taxes, and have the least amount of risk while doing it, you can go to the exchange-traded markets, where I stood on for 10 years, buying and selling options and hedging my positions sometimes by doing short selling. You see, but people can go ahead and go to those exchange-traded options and go protect the large value they may have. Okay? However, that maximal management of those options adds to the cost to the company. You see, and so they don't want people to manage them so that they end up by getting the most money with the least amount of risk. They want them to have they want them to be at risk, and if they want to reduce the risk, they want them to pay a good big penalty in the form of forfeiting part of the value and paying an early tax. Now, when the people exercise those options early, the company gets three benefits. They get part of the value forfeited back to them, and they also get two cash flows, one of which comes from the exercise price, and another that comes from the fact that they can deduct the difference between the exercise price and the market price from their taxes as if they actually paid the employee cash. So, and there's a lot of controversy right now where Senator Levine is out there promoting again the elimination of some of the benefits tax-wise that the companies are taking as a result of these early exercises. You see, so the companies understand that if the employees manage those grants of compensation, whether they are options, which is the largest element and the most difficult to understand the value of, the company doesn't want them to manage them maximally because it raises the cost, and they lose some substantial benefits if they exercise early. The company gets substantial benefits. And so you have the whole industry of wealth management and advisors are afraid to tell the employees what's the best way to go, because they're going to get heat from the companies. For example, if you're Morgan Stanley or J.P. Morgan or Schwab or Merrill, they actually act as investment bankers for a number of companies. And so they are acting as investment bankers and at the same time acting as advisors to these grantees or these employees who are holding large amounts of compensation. And so they have a conflict of interest.
Obviously.
So what they do is they try to stop the people from maximally managing these things because they want them to manage them in a manner which benefits the company.
Why is it that there's one of you?
Why is there? Because there's only a few people that have traded and who have actually also taken upon the task of understanding this arena of employee stock options. And guys that are very good at trading probably over the years piled up enough money they don't have to fight companies in something obscure like employee stock options. But I got on to it a few years ago, and I wrote a book